and you could probably kick it off.
All right, guys. Welcome to the HBCU to Startup Hangout, Google Hangout with the Honorable Mr. Brian Dixon. Excuse me. We want to go through this and start off as introducing ourselves briefly to kind of get a sense of our backgrounds and things of that nature. So my name is Ryan Rucker. I'm a graduate of Morehouse College. Previous to starting to build my own mobile app, I worked at Google and also Deloitte Consulting, and that's me. And I'm launching an app called Charmer in January. And then you can go ahead, Nicole, and then we'll end with Brian.
Cool. Well, I'm Nicole Boone, and I'm a graduate of Florida A&M University in Tallahassee, Florida, and I've been living in the Bay Area for about 7 years, and started out in banking with Wells Fargo, and then transitioned to real estate investment banking, and now I am at a real estate private equity tax credit syndicator in San Francisco.
Perfect.
Thanks.
Yeah.
And I'll jump in as well and introduce myself. Excited to kind of be here today to chat to you both and folks who are coming in with questions. I'm Brian Dixon, a partner at Kapor Capital, and did my undergrad at Northeastern University, focused on computer science and business, and then I did my master's at Babson College, focused on venture capital.
Okay, great. And just a quick announcement, if anyone has a question that they want to ask Brian or Nicole or I, feel free to look at the nine square icon at the top of the screen, and you can just click on that the Q&A icon to ask questions. And we'll be taking questions all throughout the entire Hangout. So I guess I'm gonna start off with a few general questions for you, Brian.
Sure.
In terms of if someone were to have an idea and have a quote unquote startup or some type of app or website or what have you, at what stage in the process should they approach a person like you?
Sure. Great question to kind of start this off and kind of really to set the context.
Right.
So Kapor Capital, we're a seed stage impact investment firm located in Oakland, California. I've been with the firm for about 4.5 years, and I started as a pre-MBA intern, to intern to associate to principal and now partner. So I've had a chance to kind of see a lot at the firm. I think our sweet spot is companies that are going out and they're raising a seed round. What does that mean? Because that term has changed a lot over the years. So I think the first round of financing for most startups is kind of this friends and family round. And I say that with the air quotes because not everybody has friends nor family who can invest, $100K, $200K into their startup. So that's typically the first round, or angel investors will get involved at that first round. The second round, or the institutional round, where you're raising anywhere between $500,000 and $1.5 million, is where Kapor Capital gets involved, and we make an average investment of about $100K to $250K in a round size like that $500K to $1.5 million. Companies are a good fit for us when they have a few things. I would say team. They have a full team and can kind of execute. They're not outsourcing, and they have some product built. You'll hear this term a lot during this chat. Minimum viable product, or MVP, comes from the Lean Startup, a book by Eric Ries. And they've got some traction. They have customers who find real value from what they've built thus far. And at that point, they're ready probably to start having conversations with investors.
Great answer. Um, and Nicole is actually going to do the pleasure of asking Brian questions geared toward his career.
Sure.
Um,
Yeah, so I think kind of just to take it back to square one, is there are probably people in this hangout that maybe aren't familiar with the venture world or are in, I guess, a career that's totally outside of that. But, being in the Bay Area, thinking like tech is cool, venture capital is cool, I would like to kind of see what it takes to maybe pursue a career in that without prior experience. So I'd love to hear your thoughts on just what are some of the steps that a person can take if they decide that a career in venture capital is something that they want to pursue?
Yeah, no, great question. So a few things. I think one, for everybody kind of viewing, uh, if you know what venture capital is, you're already doing much better than I was at your age. Because to be quite honest, I didn't know about venture until I needed to raise venture capital, and that was almost too late in many ways. But I'm glad I found out about it. Um, I discovered venture through startups and doing startups in undergrad and kind of presenting in pitch competitions. Got lucky or fortunate to place second place in the New England Innovation Fest. And that kind of really helped get mentors and a bunch of folks involved. So I'd say a couple things if you're interested in venture. One, I would say know the current landscape. Venture capital is similar to investment banking, right? It's a challenging industry to enter, right? And I say that not um, to tell folks not to pursue it, but more so just to know kind of the landscape and kind of how things work, and know that it's fierce competition. With that said, you can prepare yourself in many ways. I think one, experience. You might not have experience investing, and that's the case that I entered venture capital with no experience as an investor. But how can you get experience? So understanding startups, key. Having worked at a startup, you don't even have to start your own company, but having worked at a startup, getting that experience to know what happens. What does a seed round mean because you've worked at a company that's raised a seed round, and how does it operate? How does it all work? Those things can really help you get your foot in the door. I'd say the second thing you can do is try to develop an expertise. Find something you're passionate about, who would want to be an investor in that space. Um, Holding a cup here that's Imagine K-12. This is an EdTech accelerator here in the Bay Area. And having spent, if you've spent a lot of time looking at EdTech products, maybe worked at an EdTech company, and then you're going out to become an EdTech investor, it's a story that really gels together really well and puts you in the best position to go after a firm that might be focused on education. Same thing for health, same thing could be said for fintech. Developing expertise or having an opinion backed up by research or data will really help you get your foot in the door.
Cool.
Yeah.
And then I guess two follow-up questions to that.
Yeah.
The first is how relevant do you think like an MBA or some type of graduate degree is? I guess that would be the first question. And then after that, what are some books or materials or websites that you tend to go to get a lot of knowledge?
Yeah, great question. So the MBA question, which is it's a common one. Uh, I think it depends on where you are in your career, right? So if you're, we just got done hiring, and I ran that process for Kapor Capital. So we hired an analyst and an associate. So the answer varies per position. So if you're kind of 0 to 3 years out of school, you're most likely looking at an analyst position. No MBA required for that type of position. What isn't important is that you have relevant experience in startups. Hopefully you have a technical background of some sort, which could help because you're at that early stage or at the stage of an analyst in your career. you're really looking at a lot of deals. You're probably working through the deals that come into a venture firm. You have to be able to decide, yes, this is a deal that should go to the partners, and this is a deal that is not quite a fit for us. So no MBA is needed for the analyst position. I think the MBA, when you look at the associate or principal positions, I don't want to say it's required, but it helps a lot. And I say that because when you look at venture capital, it's a mixed bag, right? You have some founders who've sold their companies, successful companies, and then came back to venture with not even a college degree, right? One of the things I did when looking at trying to enter venture was, what's the best way to give me the highest probability to get in the door? This is having done tech startups, having done a technical degree for undergrad, and for me, the answer to that question was there's a high correlation between having an MBA and making it in the door for venture capital. So that was a decision that I pretty much built, or strategically tried to build my MBA around getting into VC. And that starts even before you step foot on campus, to be honest. The summer before going to school at Babson College, I spent that summer working at Kapor Capital, so doing a pre-MBA internship through an organization called MLT. And I think that really set me up to come back for the second summer and then ultimately convert to full-time. So, yeah, I think that, if you're thinking about an MBA, this is a one path into venture. It's not the only way. I think you can always do informational interviews with venture capitalists to kind of find out, and that's what I did. How did you get there, right? And what you'll learn is that everybody has a different path, right? And everybody has a different way to get there. But you'll see that there's some common threads through all the folks that you meet, and you try to take those common threads and say, okay, how can I line myself up to have some of those common threads? And I think the MBA is one of those things.
Cool.
Great.
And second question, I've got a little list here of books. So we have summer associates, summer interns that come and work at Kapor Capital every summer. There's definitely two books that I recommend they read before they start, and for new employees as well. So I'll share that with this group here. First book would be The Lean Startup by Eric Ries. It's a great book for founders. It's a great book for folks who are interested in venture. It's kind of the blueprint for how startups actually get started in Silicon Valley. It's in some ways the best practices of, what's the cheapest, quickest, most efficient way to start a startup, and really helpful guide to kind of understand the landscape, whether you're starting a company or investing in a company. The second book I would recommend is Venture Deals by Brad Felds. And this book is important, and I still refer to it all the time because it really provides a landscape for seed stage investments and how to think about it. It's written in a way that it's truly for entrepreneurs who are going out to raise their first round of financing, to understand what is the investor thinking on the other side of the table. What provisions in a term sheet are actually important and that you should negotiate. And if you think about it from a founder's perspective, they're going through this for the first time, right? And a lot of founders might not have, two buddies who just raised a seed round, 3 months ago, and two cousins who raised a Series A year ago. So how do you help everybody, right? And I think that book allows you kind of unlock some of the secrets that if you don't have anybody in your network to ask those questions, you can kind of refer to that book. So really helpful, and I recommend it to everybody on this chat, and folks who might check in on the other mediums as well.
Okay, definitely great answers. And just to recap on those books, that was The Lean Startup by Eric Ries and Venture Deals by
Brad Felds.
Okay.
Yeah.
And that's definitely some interesting things that you brought up. I guess a question that I had um, was, when entrepreneurs, approach you and pitch you, what are some common mistakes that you see when they pitch to you?
Yeah, it's a great question. I would say this, um, having pitched before, I get it. It's not easy, right? And I think I always try to bring that mentality when looking at an email, when getting pitched at an event or anywhere, right? So I think um, when you look at the numbers of kind of who gets funded, right, and you know they're not good, I think, across the board. Common mistakes, I would say, the first and probably most common is we're raising $1 million to go hire the team and go build the product, right? And it's a chicken and egg problem because it's like, well, if I don't have the $1 million, then I can't go build the product, right? And most VCs, especially at the seed stage, have a luxury, right? They have a luxury that entrepreneurs are going to come in the door with the team, with the product, and with some traction. And that's kind of from an entrepreneur's perspective is the landscape, right? So if you're looking at a deal, same concept, and one has those three things I mentioned, and one doesn't, and they're raising $1 million to go do that thing, the first business is just less risky. And although VCs and investors are supposed to be, very, very comfortable with risk, we're trying to minimize risk, right? And I think that's the first mistake that entrepreneurs make is they're going to raise money to go do the thing that they are raising money for. I would say the second thing is that they don't use their network, right? So when you send an email into a VC firm, the best way to get a VC firm's attention is by using portfolio founders or common connections you might have to somebody on the team. And I understand this is kind of, not everybody has that network, but if you do have that network, use the network, right? So if you happen to know somebody who knows somebody who can make the introduction on your behalf, those emails for most firms go to the top of the queue. In the case of Kapor Capital, we know that not everybody has that network, and what we try to do is we allow folks to submit their business plans via the website, and you actually get a response. And that's not the case for a lot of firms. You kind of send it in, and it's a black box, and I've gone through it as an entrepreneur, and that's something that we've really taken into account for how we try to help or interface with entrepreneurs. So those two I think, are probably the most common. I think, I can go into the deck and kind of every chart in the deck is always up and to the right. It's always in a big market, and we heavily discount those things because we know that they all look big and they all look great.
Okay, great. And I just before we proceed, I just want to remind all the viewers, if you have a question, it's at the top of the screen, a 9 square icon, and you just click, and then you click on that, and then you click on the Q&A icon to submit your questions, and we're gonna definitely get to those questions. I guess to follow up on that question I asked, someone had another interesting question submitted just to me on my Facebook. He says, "What do you think about the future of the shared economy model?" So I guess he's assuming an Uber perhaps, or Airbnb, where,
Yeah, I mean many things. One, Kapor Capital is a seed stage investor in Uber, right? So Mitch and founding firm, the founder of the firm, and Frida were around and made an investment directly into that round. And to kind of watch that company over the years, it's the unicorn of all unicorns in many ways. The 1099 economy is constantly changing. I don't know where we'll end up, but I think that we've already seen some of the effects of the classification of employees and the impact to businesses. I think HomeJoy is probably the most recent, where the company shut down because of this classification issue, and for some other issues as well. Um, you know, I go back to the basics of business, right? Of if you are charging people $10 an hour for X, whatever it might be, and you make, uh, um, and you pay out $12 an hour, um, that seems like a fundamental problem with a business. And I get that's something you could do short term, but I think that we really have to think about long term. How are these companies going to be sustainable? And obviously, fundraising. There's plenty of dollars in the private markets, and you're seeing a lot of that now today. But a lot changes when these companies go public. And I think you're starting to see, especially in the 1099 economy or the shared economy, that these companies are staying private for a pretty long time, longer than they've ever stayed private before. And I think there's still a lot to be figured out, not only on the business side, but to be quite frank, there's going to be a lot more cases, legal cases, to kind of figure out this classification issue. And it might be that it's a hybrid that's created. It might be, the laws were built in a time where this wasn't, they weren't built for these companies. And I think that there's got to be some adjustment. I just can't tell where we'll end up, but I know something will happen. So.
Great answer.
Yeah.
Cool. Well, Brian, what is kind of the day-to-day like for you at Kapor?
Yeah. So I'll say this. Venture is exciting. You start the year, right? And I'll kind of jump into the day-to-day, but you start the year, and as we come up to 2016, with a blank canvas, right? Of you don't know what the investments are going to look like for 2016. That's probably one of the most exciting parts of the year. Is you've got the slide, and it's 2016 investments, and it's blank, right? So that's the first thing, is that you don't know what you're going to see. There's things that interest you. You kind of out there looking for it, but there's no telling what's going to come in the inbox or who you're going to meet over the course of the year or who you're going to get introduced to. I'd say, day to day, it's first and foremost, you're always looking at the inbox of deals that are coming in. That's probably, that's our source of kind of the business that we're in. So spending some time kind of going through and just seeing what's come in over the last 24 hours. So that takes up a bulk of time. The other side of things is really trying to meet with founders. I always say that if you spend a day and you kind of haven't met with a founder, it's like, well, what did you do for that day? And a founder could be a new founder who's not in the portfolio, or a founder who's in the portfolio who might need help on strategy, who might be raising a bridge round or a Series A. You really want to spend time with the founders. I mean, that's our goal, is to make investments and try to help the founders have the best outcome that's possible. And that sometimes that might be making introductions. I think the third thing I spend some time on per day is really just strategy and kind of playing a quarterback for the team. Having been there for 4.5 years, you have a chance to work on many deals. You have a chance to work with many people. And there's a lot of things that just need to be coordinated. So I mentioned we had 2 great hires for the analyst and associate position. I'm really excited to have those folks on board. So it's really ramping them up, getting them up to speed. From the partner side of things, really trying to make sure that we're not missing or dropping the ball with any of our entrepreneurs. And then I think a part that really isn't talked about as much, and I think I kind of chalk it up to the Shark Tanks of the world, right? You kind of see it as you're out there, you're cutting deals, you're investing in entrepreneurs, you're traveling, you're flying, those are the things that I feel like the Shark Tank effect, right? But there's a part of it that's that's just fundamental. You got to just get stuff done. So I'll give you an example. You're reviewing documents, right? You make an investment. you're going to invest 100K. Great. There are documents that are attached to that investment. You're going through them. You're making sure that all the numbers add up. You're looking through the cap table. You're reviewing the terms, or you might be generating terms. For the Series A, it's probably a bigger deal. It's a document stack of at least 150 pages. You're going through those, and that's that's the part that you don't hear much about. I think calls like this is the kind of, if you're interested in VC or kind of just to give you more insight. Yeah, you're reviewing documents a lot, and you're making sure that the wires go out on time, and to the right companies, right? That's the last thing you want to do is mix those things up. So there's a lot that happens behind the scenes, I think, and there's a lot of just process in place, at least for now. Those things don't get talked about as much, and it changes too, right? If you have your own venture firm, which is a whole different thing, you're reporting to your limited partners, right? And limited partners are people who make investments into the venture firms so that the investors can then go invest, right? You're providing updates to them quarterly. You're managing to make sure kind of to track your returns. So there's a lot. There's a lot to it, and I think there's over the course of a year, it evolves and it changes, right? You make an investment today. Let's say you put 250K into $1 million round, and you're going to track that company from today all the way to hopefully Series A, and that's the job. That's the nature of the role. And it's not just all hitting TechCrunch, Disrupt, and kind of all these conferences that you hear about. There's a lot more to it that doesn't get talked about as much.
Okay.
Yeah.
Thank you for that. So we have almost an unlimited supply of questions now.
Sure, fire away.
And it's 7:30, so we want to kind of get through all the questions. The first question is from Corbin Bell. Thank you for your question. What's your view on the blockchain technology?
Oh man, that's a hard one. I am probably the worst person to ask that question. Talked about focus, right? And I focused in the last 4 years on really about education, fintech, and kind of more so of like just enterprise in general. Blockchain, I've got nothing for you. I haven't spent any time in the space. Corbin, I can try to connect you to some folks actually who spent all their time focused on that, but I'm not the guy to answer that question. So I'm off to a rough start.
Okay, so the next question is from Joshua Chestang, and his question is: can high-fidelity mockups, early signups, and a team suffice for raising a seed round?
I'll say this. It's just not enough. And I know that's a hard answer to say, and I'll tell you why. I think the mock-ups are great because they show what you're going to do, right? And having some signups are great as well. In most businesses, you can kind of fake it, right? And when I say fake it, meaning, it looks like it's an automated system, but in the actuality, it's people running 1,000 miles per hour to kind of get the thing going. And I think if you can do that, that's helpful, and that can kind of get you far enough. I think if you have a CTO on board, and we talk about team, and in Joshua's question was, you have the team. And a part of the team is that CTO role, and he or she, has to be able to deliver something to get you to the point where I can load it up on my iPhone or I can load it up on the computer and kind of see what the customer experience would be. Now, granted, it doesn't have to be the full-blown experience, but I think when I think about mock-ups, you can't interface with mock-ups. Yeah, sometimes you can kind of click through and kind of walk through to get a feel for it, but the customers aren't really going to see the value in a mock-up. The mock-up will get them to sign up, and maybe after they sign up, you're kind of walking through the process manually, but you've got to cross that line of, we've got something built, we've actually shipped something. It's almost, for that seed round, it's important. Yeah.
Okay. And the next question is from Liu Jones.
Okay.
What is your take on the digital health sector and the future of VC investment? Excuse me.
Yeah. Um, and the question was about digital health. Is that right?
Digital health and the future of VC.
Yeah. I'm excited about it. I am a wearable, uh, you know, gadget kind of person. I have a, Apple Watch. I've had a Fitbit. I've had a Nike Fuel Band. None of them really got me to do any more working out, to be quite honest. But I think they're cool. And I think that you think about health, and this is just my experience, is like it never goes well, right? It's kind of like, you go to the doctor's office and you just wish, man, this could be a better experience, right? And, some people feel that way and a lot of people don't, but a lot of people feel that way, right? And I think that that's a chance for technology to help optimize that system, right? The other day, I have Kaiser here in Oakland, and they said, well, do you have your records, right? And I'm like, my records should be like accessible somewhere, somehow. I should be able to get them, right? And I had to call my doctor back in Boston. I had to get a fax. It's like, it's so much, it's so much work. Now, granted, I'm fortunate to have healthcare and I'm happy about that, right? But I think that there's improvements, right? There's a lot of costs that are involved. It's like, why does it cost so much, right? Like, how can we get these costs lower? So that's the way we kind of think about things. One, why is the cost so high just to begin with, and how can technology actually help that? How can it help with communication? And that might be doctor-patient communication. There's just many ways that technology can actually help. And I would say for the person who asked the question, they should look into an accelerator called Rock Health. Really interesting, really, really interesting accelerator program.
Okay.
Yeah.
Great. Next question is, has crowdfunding changed venture capital in any way?
Oh, absolutely. For good and for bad. I think the good, right, is that before, let's say 5 years ago, before Kickstarter, right? If you wanted to do a hardware product, it was very hard to show, you're the team to pull it off, right? Or a lot of people want this, right? And I mentioned the grass row is up and to the right. With crowdfunding, you can actually start to prove some of that, and I think that's really meaningful. I'll give you an example as an antidote. We have a company in our portfolio called Formlabs. It's a 3D printer, high-resolution 3D printer. And the question is, well, one, how does a high-resolution 3D printer help with social impact? And two, well, why did we make the investment? And I'll tell you why. So the first is that Formlabs, those type of 3D printers in the past were only accessible for folks who had over $10,000, or really about $20,000 to go buy a really high-end 3D printer. And the second thing was, or connected to a university of some sort, right? So if I was an independent contractor and I wanted to create some 3D models, I really had nowhere to go. So if I'm bidding on a contract per se, and a part of that bid is a 3D model, well, what do I do? So this helps kind of unlock who can participate in a lot of the creation process. And I'm going back to this story of crowdfunding. Well, how did it actually play a role? So if you didn't believe that 3D printing, as from a venture and as an investor, was going to be a big deal, your perspective would change on that, because Formlabs had a Kickstarter, and they went out to raise, I think it was $100K on Kickstarter. They ended up raising $2.9 million from backers on Kickstarter. And there's no arguing the point of, well, people don't want 3D printers, or they don't want high resolution 3D printers. It's very clear from seeing the response on Kickstarter that 3D printers in this company has proven their traction. And this is before they shipped one printer at all, right? They were able to go out, take that traction of the 2.9 million and raise venture capital funding just based on that. Not only that, it's equity free, right? So it's actually pre-sales. That 2.9 is actually going to hit, as far as sales. And I think that those are all great things, and those options weren't around prior to crowdfunding. I think the second wave of changing venture capital, absolutely, it's going to change it. The Jobs Act Title 2, or Title 3, I believe, 2 or 3, I'm not exactly sure. But the Jobs Act is going to change who can invest in companies. There's a clause today where in order to be a accredited investor, you have to either make 200K per year for the last 3 years, or have $1 million of liquid assets, not including your primary home. And not too many people make that criteria, right? So this change, or this act, will allow everyday normal folks to have a chance to invest into tech companies. Obviously, it will be capped, and that's what they're trying to figure out now from the SEC. But I think once that act goes into effect, we'll really see the power of crowdfunding. I think if you go talk to the folks who backed Oculus Rift and then sold to Facebook for a few $1 billion, those folks wanted to be, some of those folks said, well, we helped build this company up, right, even before we received any virtual reality device. And crowdfunding as an investment stake or equity stake will really change that. So it's going to be exciting to see how it all plays out. It's going to be messy, though. I feel like you never know how these things are going to end, but hopefully they'll get it right.
Cool. Well, thanks for that answer. It looks like our next question comes from Fatten Cooper from Bethune-Cookman University, and the question is, how would one sell or invite the concept and reality of sweat equity to students from a low-income background?
How would one sell or invite the concept? And what do you mean by, I guess, sell or invite the concept?
So I'm thinking that she's getting at, the value of sweat equity and working hard.
Yeah.
And is that seen, I guess, as a valuable thing when pitching a startup?
Yeah, got it. Yeah, I mean, let's be honest. I think that there's a few things at work, right? So, the numbers, and she mentioned low income background, right? That was a part of the question.
Yep.
Yeah. Okay. So, if you have a low income background, historically you've been at a disadvantage, right? You have less resources. You have to, and it's kind of the same thing of, we look at folks who graduated college and they're doing a startup right out of school, right? And some folks who just graduated, recent graduates, they don't have any college debt. They have no family to support. They don't have to send money back home to mom and dad, or to grandma, or to really supporting their siblings who might be going to college as well, right? So if you take that entrepreneur, and you take an entrepreneur who, I've got 3 brothers, and the mantra in my house is that as you go to school and you graduate, you help support the sibling behind you. That's just the way it is. That's the way it's always been. And you still have to kind of go out and compete with other folks who don't have that. Or, we have student loans, right? And I think my parents did a great job of getting us through school. But student loans were a real thing, and you had to kind of take them out. That's just the way that things were, right? So I'm not going to say that they're equal at all. I think that you've got to work harder for sure. I think that you've got less resources to work with, and that's a fundamental. That's what makes, I think, entrepreneurship just unfair in many ways. Of that, like I said, the friends and family around. Hey, it's really easy to get started when you've got 100K to start with versus 0 to start with. I think that the good news is that technology, in many ways, helps to level the playing field, in the sense that you can build a product pretty cheap nowadays. You can get pretty far using online resources. to help level the playing field in that way. We try to take that into account. I think that most people do, um, but that's not across the board, right? If it's kind of we always talk about the distance traveled for the entrepreneur of kind of where did they start from to get here, right? And that actually plays a part, right? Because everybody's not starting at the same point. So we definitely try to factor that in. Um, there are still things that have to be done, right? And I think that that's important as well to say. So, having a CTO is a must. Having an MVP is a must. And I think it actually works to your advantage. A lot of the times when we make an investment, the main question that we ask is why? Why are you working on this? And in that why, you'll find out that, we just did a deal from a company called Student Loan Genius, and I hope um, actually the founder's story of taking out over 100K worth of student loans and having to pay it back, and still paying it back, and then building a product to help solve that thing of helping people crush their student loan debt by building a 401k for the student loans is why he's doing it. And you'll see those stories all throughout the portfolio of kind of why. So I would say that sweat equity is important. Your background of distance traveled is important, and I hope that whoever's investing in your company takes that into account and actually looks at it as a positive, not a negative.
Okay.
Yeah.
Great answer, Brian. The next question is from Corbin Bell, and it is 7:45, and unfortunately, this is going to be this is going to be one of the last questions that we ask. So definitely make sure that you get some questions in, and we'll try and escalate the process to get as many questions as possible. Do you see yourself becoming a founder again? If so, what type of startup would you start?
Oh man, I'll say this: starting a company is hard. It's hard, um, and I do love it. Like I can honestly say it's one of the things that um, you know just thinking about starting a company, right? Of like you don't know if it's gonna work. You don't know how hard it is. You don't know if your teammates are going to be around. I've been fortunate to work on 3 startups before coming to the investment side. Um, you know, painted shoes, one company called Blackout Sneakers, and painted shoes for LeBron James when I was in high school. And if you go to blak-out.com, you can kind of, hopefully it's still up, see the picture of a pair of shoes that LeBron James is holding that were in my house, probably 72 hours prior to LeBron holding them. That's the kind of power of startups, right? Of like a high school kid can create some shoes with Photoshop and use the internet to sell them on eBay and build a storefront and sell hundreds of shoes to people. That's kind of the magic in it, right? And you kind of never lose that magic. And I ended up doing 2 other startups with great co-founders, and we raised some angel money and pitched to probably too many seed stage VCs and got too many no's. But you still love it at the end of the day. And I think as an investor, you get a chance to see that story told over and over, and you kind of get to see founders' eyes light up, and you kind of see them travel and go through the whole life cycle. That never gets old for me. With that said, at this point in my career, in my life, I really do see myself staying on the investment side, on the investor side. I did 3 startups from, I don't know, 2000 and really 2000 to kind of 2011 or so, or 10, even in the MBA, kind of still flirting with it before going back to do an MBA. So I've kind of got it out of my system. But I'll say this: it's like Michael Jordan. They say that if you're going to retire, right, and you always left that crack, the little crack open for a chance to come back. And I think that if there's something that I really do feel would make a difference, and I feel extremely passionate about, and it was kind of my calling. You kind of just got to follow your calling. So that bug hasn't hit me yet. Having a lot of fun at Kapor Capital and kind of seeing it from the other side, and trying to change the story of kind of who gets funded, right? Because if you look at the numbers, and I've got to say this, 2% African American of VC-backed companies, 8% for women, VC-backed companies. Those numbers got to change. I mean, we're at 48% in our portfolio, and the goal next year is to do over 50%, either a founder of color or a women founder. And I think that not only helps change our portfolio numbers, but other folks who we co-invest with. And that's what gets me excited to kind of get up every day and try to change the story of who's doing funding and kind of who gets funded.
Great.
Cool.
Yeah.
Well, our next question comes from Joshua Chastain.
Sure.
And the question is, any thoughts on how to convince family to join your first funding round?
That's a tricky question, because I think that if family's joining your round, they're doing it because a lot of times not because of the business, right? They're doing it because there's a relationship there. They believe in you, and whatever you're starting, it doesn't really matter probably. They just want to be supportive. So I think that you also want to count that 98% of startups fail, right? And even inside of our portfolio, there's going to be a very, very high failure rate. So if you're taking money from family or from friends, you want to remind them of that. Of, hey, I really believe in this. I'm going to spend my time doing this, but just realize that any investment that you make can go down to zero, or it could go to however X. But I think you want to just remind them of the risk involved with startups in general. And if that's fine with them, yeah, go ahead and kind of take it. I would try to treat it like a business relationship, and this is more personal than kind of best practices. So if you have a pitch deck that you present to other investors, present it to family, right? Give them the opportunity to ask questions as if they were not your aunt, right, and your uncle. So give them a chance to really go through that process, rather than, hey, you're kind of texting them, hey, this is the thing I'm working on, right? Like, that's not the best pitch, or I think the best business relationship you want to enter. And that's what this is in many ways it's a business relationship.
Well, that's going to be the last question. I just want to take the time, to thank, Nicole, Brian, and also Hadia, the founder of HBCU, the startup, for taking the time to plan this out. And I'm just going to ask Nicole first, and then Brian for some final thoughts that we can conclude on, and then how people can get in contact with you.
Yeah, so I mean, I would just, Ryan, echo your sentiments and your statements. I think this has been great. Brian, thank you for your time. I certainly know that I've been enlightened, and I think everybody on this call has been as well. And then, thank you to HBCU to Startup for launching this platform for folks to get together and ask questions to some really prominent folks. So thank you.
Yeah, great. And same to you, Ryan, and Nicole, and to Hadia as well. I think about the resources available back in 2001 when I was getting started, and this wasn't available, right? And I think that having an opportunity to kind of talk about these topics and try to share any knowledge that you've kind of picked up along the way to help folks who might be maybe 5, 10, or even a year behind you is helpful, because I'll say this: I didn't make it to a partner at Kapor Capital by myself. And there were a lot of people who poured a lot of time and effort and energy into helping me reach that goal. So I think it's only right to spend time and to try to make yourself accessible to folks who could even use one tip. So if you've even taken one tip away from this, I think it's time well spent. So I'm excited to see what you guys folks on the line kind of end up doing, and hopefully this resource and HBCU to startups is a great resource for folks to kind of have a network that they might not have otherwise. So excited to be supporting this type of program, and my startup handle is kind of floating around. It's at Mr. Startup. I was pretty early to startup, or to Twitter rather, and my email is publicly available as well. It's just Brian at kaporcapital.com.
All right, great. Thanks again. And I guess we're gonna conclude now.
Perfect. Thanks again. Have a good weekend.
Thanks, everyone.